Students, if I'm not wrong, admin has shared, I think, around 4 questions with you. Then all 4 questions, they were homework. So now basically we'll be doing all the recent past papers. So the target is that we should be, there should be a discussion on all the recent past papers. And obviously, I think either tomorrow we will also discuss your sustainability S1 and S2, inshallah. And please, I want everyone do give the mock. Basically, attempting the mock gives you the opportunity to face the same environment which you're going to face in exam. And the benefit would be, even if something goes wrong in this mock, you will still be having a few days. You can improve yourself. So try to give the mock with full dedication. So let's see what is going to be the day for the mock. Saturday or Sunday, I don't know. Tomorrow, otherwise on Monday, admin will let you know. But from here onwards, I'll keep taking the classes and the whole focus will be on latest past papers. So that we should be discussing the latest past papers. And tomorrow timing is, tomorrow I want a little bit long class, I think. Timings, just an idea I'll give you, then we'll start the class. It's tomorrow, it is 2 p.m. inshallah. Don't worry, admin will share the message. Let me start this discussion of our course. Well, how many of you have attempted all the 4 homework questions? All 1, 2, 3. What is the progress? No idea at all. Only 2. What about others? Okay, that's great. Because these days are very important, students. Try to complete your lectures as soon as possible so that you can focus on the, obviously, revision. The more you revise, automatically you will get a really good grip. Okay. Benito, this question came in September, December 2023. So obviously, we will consider this as a very recent attempt paper. You cannot say it's an old paper. It's a 25 marks question. In accordance with IFRS accounting standards, describe how an entity assesses whether the transfer of an asset qualifies as a sale. Number 1. They're asking us, describe how an asset assesses whether the transfer, entity assesses whether, describe how an entity assesses whether the asset, whether the transfer of an asset qualifies as a sale in and sale and leaseback accounting. Now, please listen carefully. How an entity is going to assess that transfer qualifies as a sale whenever the word sale comes, sale. Then IFRS 15 should come in your brain. Sale means we are talking about revenue. And obviously, the IFRS which deals with revenue, that is IFRS 15, revenue from contracts with customers. An examiner is asking us describe how an entity assesses whether the transfer of an asset qualifies as a sale. Now, student, listen to me carefully. Whenever the word sale comes, so immediately IFRS 15 should come in your mind. And the second, can I say revenue will only be recognized? Revenue will only be recognized. Sale will only be recognized when actually seller has satisfied the performance obligation. Performance obligation means the promise which seller has made. If seller has fulfilled that promise, then obviously you will recognize the revenue. You will recognize the sale. Now the question arises, how do we know that performance which seller has made, that seller has satisfied that performance obligation or not? It's very simple. When seller has actually transferred the control of the asset to the customer, it means you have fulfilled the promise. You have fulfilled your performance obligation. And when I say that I have transferred the control of asset to the customer, it means now it is up to the customer how the customer want to utilize that asset. Repeat. How an entity assesses whether the transfer of an asset qualifies as a sale in sale and leaseback accounting? The answer is very, very simple. And the answer is number one, can I say entity will be using IFRS 15 revenue from contracts with customer? And sale will only be recognized when the seller has satisfied its performance obligation. And satisfying performance obligation means simply seller has given the control of the asset to the buyer, to the customer. So it means now you should be recognizing the sale. Now listen carefully. When we say sale and leaseback, can I say you cannot apply leaseback accounting until unless the first sale has to occur? Is this clear to everyone? How can I apply a leaseback accounting? Until unless if the sale has not occurred. So first sale has to be there, and after the leaseback accounting will start. Is this clear to everyone? Look at this sale, and after that they are saying leaseback. So obviously the leaseback issue comes later on. First there has to be a sale. Student, please B1. Is this clear to everyone? That entity will assess that sale will only be recognized when seller has satisfied the performance obligation. And satisfying the performance obligation means simply seller has given the control to the buyer. If the control is transferred to the customer, it means you have satisfied the performance obligation. And obviously, first, there has to be sale, and after the leaseback accounting. Now, let's see what they're asking after that. Explain how sale and leaseback transactions are dealt with by the seller lessee in accordance with IFRS 16 leases if the transfer of an asset qualifies as a sale. Now, they're asking us just to discuss the accounting treatment if the transfer qualifies as a sale. Can I say, I'm just giving you the idea. If the transfer qualifies as a sale, so number one is, can I say you have to de-recognize the asset? Yes or no? I'm just giving you the idea. If transfer qualifies as a sale, then first you need to de-recognize the asset. And can I say and record gain or loss on disposal? If transfer qualifies as sale, then obviously you need to de-recognize your asset and record, and you need to recognize gain or loss on disposal. Can I say lease back? Explain how a sale and leaseback transaction are dealt with the buyer seller lessee in accordance with if the transfer qualifies as a sale. If it qualifies as a sale, so number one, you need to de-recognize the asset and recognize gain or loss on disposal. Can I say second, you have to record a right of use asset. Right of use asset and lease liability. Two things. Simply, if transfer qualifies as a sale, you have to de-recognize the asset and recognize the gain or loss on disposal. And second, you have to obviously recognize the right of use asset and lease obligation. Then, right of use asset needs to be depreciated over lease term, normally, over lease term. Right of use asset will be depreciated over lease term. Fourth, can I say finance cost will be recognized on lease liability? Can I say finance cost will be recognized on lease liability? Yes or no? Obviously, later on, you need to depreciate right of use asset on lease term. Finance cost will be recognized on lease liability. Another thing is your lease liability. Can I say your lease liability will be equal to present value of rental payments? Your lease liability will be equal to present value of rental payments, annual rental payments. So these are the things which you just need to discuss. If asset qualifies, if the transfer qualifies as sale, step one, de-recognize the asset and recognize gain or loss on disposal. Then obviously you're going to lease it back. So right of use asset and lease liability will be recognized. Right of use asset will be depreciated over the lease term. Finance cost will be recognized on lease liability, and lease liability will be equal to present value of the rental payments. I've just given you the main crust, you can say. Obviously, you will be writing in a proper way. But these are the points which you just need to cover. Because in A2, all these 4 points will give you 9 marks. For example, if in A1, you have just written, I would say 2 to 3 lines, that is more than enough. Describe how an entity assesses whether the transfer of an asset qualifies as a sale. So obviously, when a seller has fulfilled its performance obligation, then transfer qualifies as a sale, and performance obligation is fulfilled when control of the asset is transferred to the customer. And transfer of control means the customer has the ability to use the asset according to his or her discretion. Then explain how a sale and leaseback transaction are dealt. So I've explained these all points. So you just need to know one thing. Explanation of all these 4 points will give you altogether 9 marks. Okay. Explain how a sale and leaseback transaction are dealt with by seller, lessee. If transfer of an asset does not qualify as a sale. Okay. Now they're asking, what will be the accounting? if transfer is not qualifying as a sale. Now, please try to understand. A3. Can I say if transfer is not qualifying as a sale, so whatever amount you have received, can I say then number one, you will not be de-recognizing the asset. Why would you de-recognize the asset when transfer is not qualifying as a sale? You will not de-recognize the asset, number one. Number two, whatever amount can I say you have received, the entire amount is technically a loan for you. Repeat. If transfer is not qualifying as a sale, then number one, lessee will not de-recognize the asset. Number two, whatever amount, whatever sale proceed seller has received, the entire amount is loan for the lessee, you can say. Is loan for the seller. Loan means financial liability under IFRS 9. Let me repeat. If transfer is not qualifying as a sale, then number one, asset will not be de-recognized. Number two, the entire sale proceed will be recognized as a loan financial liability under IFRS 9. I hope this point should be clear to everyone. When transfer is not qualifying as a sale, then what is the accounting treatment? Student, is this clear to everyone? A3. When transfer is not qualifying as a sale, then what should be the accounting? You can please comment on that. Is this clear to everyone? The one student is saying yes. What about others? Okay. Now come here. This was A3. A4. Explain the effect on accounting treatment if sale and lease back agreement contains a call option, under which the seller lessee can, at its option, repurchase the property. Very important one. Call option. Now listen carefully. Call option means right to buy. Call option means right to buy. Now please try to understand. If assuming you are the seller, try to understand. I'm just assuming, okay? Let's say you are the seller and you are selling your asset, but simultaneously you have a call option on that asset also. Call option means you have a right to purchase. Now try to understand, if you have a right to purchase, so obviously whenever things will be favorable for you, you are going to buy it because you have a right to buy. Logically, now listen, logically, if seller is having the call option, then logically you cannot, basically, if you have sold the asset and you have the call option means right to buy, it means you still have the control, and logically control will only be transferred to the buyer when option is expired. Until unless option is not expired, logically the control will not be transferred. So simply, whenever the seller is having the call option, it means the transaction is not qualifying, the transfer is not qualifying as a sale. Repeat. Students, please try to understand. Call option means right to buy, right to buy. If you are the seller, you have sold an asset, but you have also kept the call option on that asset. So it's very simple. Whenever things they will go in your favor, so you will exercise your call option. So logically, we will say that you have the control of that asset. So you should not be de-recognizing the asset, number one. Number two, transfer is not qualifying as a sale. Can I say if transfer does not qualify as a sale? In that case, in the case of call option, whatever proceed you have received, then entire proceed is treated as a loan financial liability. So sale will only be recognized when call option is expired. So you can say one thing. Having call option means the accounting will be same as transfer is not qualifying as sale. Repeat. Having call option means the accounting treatment will be same as asset is transfer is not qualified as sale. And we know that when transfer is not qualified as sale, so whatever amount you have received, the entire amount is treated as a loan. Student, is this clear to everyone? The call option point. Now, if you just come here, obviously 9 marks are there. And look at this. There is no need to refer any exhibit. You just need to tell us IFRS 15. That's it. So I strongly believe that this is clear to everyone. So let me quickly sum up. The first point, A1, how will entity assess that transfer has qualified as a sale? Can I say when obviously seller has fulfilled its performance obligation? When seller has satisfied its performance obligation means seller has transferred the control of the asset to the customer. And when customer has the control means it is up to the customer how to utilize the asset. And obviously first there has to be sale and after the lease back. Explain how sale and leaseback transactions are dealt by the seller lessee in accordance with IFRS 16. If transfer of an asset qualifies as a sale, so I have given few points. De-recognize the asset and record gain or loss on disposal. Right of use asset and lease liability will be recognized. Right of use asset will be depreciated over the lease term. Finance cost on lease liability will be recognized. Lease liability will be equal to present value of the rental payments. Explain how sale and leaseback transactions are dealt with by the seller if the transfer of an asset if transfer does not qualify as a sale, then whatever amount you have received, the entire amount is loan for you under IFRS 9. It is your financial liability. And accounting is same in A3 and A4. Accounting is exactly same in A3 and A4. Oh, no, no, please, please. They're not asking any formula. They're just asking the discussion. Right now, they're not asking any formula. They're just asking the discussion. Now, please come on point B, 7 marks. Using Exhibit 1, explain in accordance with IFRS 16 leases the accounting entries for the sale and leaseback transaction in the financial statement of Benito Company on 1st January X7 if the head office transfers qualifies as a sale, number one. And the second is does not qualify as a sale. Okay. Now let me just tell you a few things. Then we'll read the scenario obviously as well. Just an idea. Sale and lease back. One possibility, sale at fair value. Okay. How will we calculate a right of use asset? Obviously, we will de-recognize the asset which we have sold, but we will recognize the right of use asset. So right of use asset is equal to lease liability, lease obligation. And we know that lease liability is actually equal to present value of the rental payments divided by fair value of the asset. And multiply this with carrying amount of the asset sold. Carrying amount of the asset, which you have actually sold. So by using this, you can calculate the right of use asset amount. Right of use asset is equal to lease liability divided by fair value of asset multiplied by carrying amount of the asset. But this is when sale is at this is the case. Now please look at this. It is also possible that someone has sold even more than the fair value. I'm just assuming, okay? The fair value is, let's say, 8 million and you have sold it for 10. Number one, excess, how much is the excess? 2 million. It is loan under IFRS 9. It is the financial liability. Nobody is going to give you 10 million if the fair value is 8. Why would they do it? Near to impossible. So if your examiner says sale is more than the fair value, okay, then this excess is loan. This excess is financial liability under IFRS 9. Okay. The right of use asset is equal to, look at this clearly, please. Lease liability, examiner will give you. Let me use the change the color. Minus the excess amount in my example. Because you have to separate the loan from the lease liability. Assuming I'm just assuming, okay, please, assuming the lease liability is, let's say, 8, or make it, let's say it is 7. Whatever is the lease liability, you need to deduct the loan amount. So actually, the remaining will be the lease liability. Because when examiner gives you the lease liability, it has the impact of that loan as well. So you have to exclude the loan divided by fair value of the asset and multiply the carrying amount of the asset. Okay. There is third possibility as well. That is, someone has sold even less than the fair value. Obviously, why would somebody is going to do it? So that is why IFRS 16 has come up with the solution. Assuming, I'm just assuming, okay, let's say the sale value is, assuming it is 8 million. And let's say the fair value is 10. Third case is the opposite of the second case. Let's say the fair value is more, but someone has sold it for less than that. If this is the case, then this 2 million is the prepayment of rental payment. Okay. How are we going to deal with this too? Let me explain. Right of use asset is equal to, take the lease liability which examiner has given you, plus the prepayment, divided by fair value of the asset, multiply by the carrying amount of the asset. I hope it is now clear to everyone. There are three possibilities. Then how do we calculate the value of right of use asset? There are three possibilities. Number one, you are selling it at a fair value. Second, your sale proceed is more than the fair value. Then obviously excess is the loan. Third, you are selling it less than the fair value. Then difference is the prepayment. Okay. Now please come in. Using Exhibit 1, explain in accordance with IFRS 16 leases, the accounting entries for the sale and leaseback transactions. In the financial statement of Benito Company on 1st January 87, if the head office transfer qualifies as a sale. Let's see. Sale and leaseback, sale and leaseback. On 1st January 87, Benito Company sold its head office, which had a carrying amount 3.75 million to Benito Company. The cash is 7.5. On the same date, Benito Company has entered into a contract with Otinu Company to use the head office for 20 years. They sold it to Otinu Company with annual payment payable at the end of each year. Both companies have correctly accounted for the transaction as a sale and leaseback. Okay. On 1st January 7, the fair value of the head office is 6.75. Student, look at this. The fair value is 6.75 and you have sold it for 7.5. Where is the case which we were discussing? Can I say the case too? Yes or no, please reply. That you have sold it even more than the fair value. Difference is the loan. Now come here. 7.5 minus 6.75. It means 7.5 minus 6.75. The loan amount is 0.75. The present value of the lease payment is 5.47. Now look at this. The right of use asset is equal to lease liability is 5.47. Can I say I'll minus the loan amount? From the lease liability, we'll deduct the loan divided by the fair value of the asset. Fair value of the asset. Can I say the fair value of the asset is 6.75 into carrying amount of the asset? So it will give us the value of right of use asset. Let's see. 5.47 minus 0.75 divided by 6.75 into 3.75. Students, I'm getting 2.62. Please check. I'm getting 2.62. So logically 2.62 is the right of use asset. Now, let me just make a double entry for you here. Obviously, I'll share the answer with you. Don't worry at all. Everything is in a million. Cash company is receiving 7.5 million. Right of use asset we have calculated 2.62. Can I say the asset sold will be de-recognized property, plant and equipment? The carrying amount is 3.75. Okay. And lease liability? Lease liability is the difference actually between 5.47 and 0.75. That is 4 point. Financial liability or loan is the same thing. Logically, the gain or loss will be the balancing figure. If you just check the debit side is heavier than the credit side. If the balancing figure is coming on the credit side to balance the entry, then it is gain on transfer of the asset. If the balancing impact comes on the debit side, then it is simply a loss. So let me use the calculator. 7.5 plus 2.62 minus 3.75 minus 4.72 minus 0.75. I'm getting 0.9 gain. So simply gain on rights transferred. 0.9. I hope this calculation and double entry is clear to everyone. Now let's go for another part. How to found, wow. The amount, please look at this. If the sale is for $10 million and the fair value is 8, the difference is the loan financial liability. Is this clear? Case 2. If you have managed to sold it for more than the fair value, so any amount which is more than the fair value, that is the loan. That is a financial liability. Okay, now come here. Okay, students, in next point, they're just asking, does not qualify as a loan, as a sale. Can I say if it is not qualifying as a sale, then entire amount, whatever you have received, it is your loan, it is your financial liability, yes or no? If it does not qualify as a sale, so I'm just doing double entry here. Cash 7.5. Can I say financial liability, loan 7.5 million? If it is not qualifying as a sale, then whatever sale proceed you have received, entire amount is your financial liability. Is this clear to everyone? If it is not qualifying as a sale, then whatever amount you have received, the entire amount is your financial liability. I hope this part is pretty straightforward. Obviously, when it is not qualifying as a sale, you will not de-recognize the asset, and asset will remain at 3.75. It will not be de-recognized, and simply whatever amount you have received, it is your financial liability. Okay, now look at the next part. Using Exhibit 1, compare the impact of head office transfer qualifying as a sale and not qualifying as a sale on Beneteau Company's financial statement and key performance indicators, 7 marks. Okay. Now, compare the impact of the head office transfer qualifying as a sale and not qualifying as a sale on Beneteau Company financial statement and key performance indicators. First, we need to just discuss the impact when head office qualifies as a sale and when it is not qualifying as a sale. And after that, we'll be discussing the impact on the key performance indicators. Now, let me just give you a little idea first. Can I say when simply when it is sale, means transfer is qualifying as a sale, try to understand the impact on the financial statement of Beneteau. Number one, I'm just discussing the impact. Number one, can I say property, plant, and equipment will be de-recognized? Second, there will be a gain on transfer. Third, right of use asset will be recognized. And obviously, right of use asset amount is 2.62. The de-recognized is 3.75. Obviously, right of use asset will be depreciated over the lease term. Now try to understand. Can I say logically we can say that depreciation, we can say that normally the depreciation of right of use asset will be lower than depreciating the 3.75. Normally, we can say the depreciation of 2.62 will be lower than depreciating 3.75. Okay. And there will be a finance cost on lease liability. Yes or no? So when asset is when sale is when transfer is qualifying for a sale, what are the impact on the financial statement? Property, plant, and equipment with a carrying amount 3.75 will be de-recognized. There will be in fact gain of 0.9 million. Right of use asset will be recognized 2.62. It will be depreciated over the lease term. Finance cost will come on the lease liability. Now, what are the impact if it is not a sale? Not sale. Number one, can I say loan? Financial liability will be 7.5 million. Now try to understand. Loan will be higher as compared to when asset is transferred as a sale. Because when asset is transferred as a sale, then you will have lease liability in your books. Try to understand. Can I say logically your lease liabilities will be lower than the loan amount? Are you getting this point? If I compare, try to understand. If the lease liability, obviously lease liability amount will be lower than the amount of the loan. Another point. Now, interest finance cost will be recognized on the entire 7.5 million. So obviously when we'll be charging a finance cost on 7.5 million, it will be higher than finance cost on lease liability. Another point. Can I say depreciation will be more than right of use asset depreciation? Why? Because when we did not de-recognize the 3.75, so obviously the depreciation will be more. Another point. Can I say obviously no gain on transfer? Now please try to listen to me and try to understand. Can I say your loan will be more as compared to when transfer qualifies as a sale? You will be having more finance cost. You will be having more depreciation, no gain on. Can I say by looking last 3 points, you can say that profitability will reduce. If it is not a sale, logically profit will reduce. Profitability will reduce as compared to when asset is transfer is qualified as a sale. Another thing, when transfer is not qualifying as a sale, can I say your loan will be more than when your asset was when transfer was qualified as a sale? Students, are you getting the impact on the financial statement? Is this clear to everyone? Please reply. Now let's come here. Now let's see what are the key performance indicators. Just gearing. I'll give you the impact. Please try to understand. Gearing. Can I say if sale is not a sale, no sale, can I say your gearing will be high? Yes or no? If no sale, so obviously your debt will be more than when it is sale. So can I say gearing will increase if it is no sale? I hope this point is clear to everyone. Now, earning before interest and tax. Can I say if no sale, then earning before interest and tax will reduce? Why would it reduce? Please listen to me carefully. Number one, you will be depreciating 3.75 rather than 2.62. The property, plant and equipment which we will be depreciating, obviously the carrying amount of that property, plant and equipment is higher than the value of right of use asset. Number one, more depreciation. Number two, one is more depreciation because we are depreciating 3.75. Number two, can I say no gain on transfer? No gain on transfer. I'm not bringing the interest here. Why? Because interest will have no impact on EBIT. EBIT is earning before interest and tax. That is why I'm not bringing the interest discussion here. But are you getting one point? There will be more depreciation if it is not a sale as compared to when it was sale. Another point why EBIT will be lower. One is more depreciation. The second is obviously if it is not a sale, so there will be no gain on transfer. Is this clear, student? Yes or no? Okay, asset turnover. Sales divided by total asset. When it is not a sale, listen, your asset turnover will reduce. Now the question is why asset turnover will reduce. Try to understand what it is total assets. Can I say if it is not a sale, then your carrying amount is 3.75 of property, plant and equipment. If you compare this with the right of use asset amount, which is 2.62. If it is not a sale, then obviously your total asset will be higher than as compared to when it is a sale. No. Please. Try to understand right now what is happening. Have they written after selling the amount will come, they will invest somewhere and the return will come? And are they asking us what will happen in the next year? Immediate impact. Just discuss the immediate impact. If I take the loan, so what would be the immediate impact? Gearing will increase. Yes or no? Students, is this clear to everyone? Okay. Is this clear to everyone that your asset turnover will be reduced if no sale? Please comment on that. Because your total asset will be higher. Yes, it should increase, obviously. If it is a sale, your asset turnover will increase. How it will increase? Number one, can I say instead of 3.75, then you will be having 2.62. Denominator will reduce, yes or no? If the denominator reduces, then automatically your ratio will increase, yes or no? Are you getting this point? It's a simple maths. No, students, please try to understand. Right now, we are not here to decide which one is good or bad. You have to just compare if it is sale, what will happen. If it is not a sale, then what will happen? The question is how earning before interest and tax reduces when no sale has happened. Great. If there is no sale, try to understand, okay? You have to compare no sale with the sale. You have to compare no sale with the sale. So if no sale means I'll be depreciating 3.75 as compared to depreciating 2.62. So it means more depreciation. And another point, if no sale, it means there will be no gain on transfer. Is this clear now? Why earnings will reduce if there is no sale? Okay. Return on capital employed, ROC, earning before interest index divided by equity plus the financial liabilities. Can I say again, if it is no sale, it will reduce. It will reduce. Now, student, please listen carefully. If you look at this question, I would say it's a very comprehensive question. Number one on IFRS 15, IFRS 16, and plus ratio analysis. If I'm not wrong, I did mention, I think in the live revision classes as well, that in SBR, we should not be just expecting questions on consolidation, IAS and IFRS. Other areas are there. One of them is the ratio analysis. In current issues, of course, sustainability S1 and S2, they have become extremely important. Okay. I hope that everyone has the new kit. Yes or no, please comment on that. In which these questions are there. Yes or no? The latest Kaplan kit is with everyone. Whoever does not have it, please just ask in your WhatsApp group, then someone is going to share with you. Do ask in the WhatsApp group. Okay. So students, here it is quite late, not at your side maybe. So tomorrow the class timing is a bit earlier, far more earlier than today, of course. And tomorrow I have planned to discuss one is sustainability S1, S2 plus the remaining 3 questions of the homework. And after the discussion of the remaining 3 questions of the homework, then in the next week, I'll be giving you a homework of around 5 to 6 questions. I'm not asking to do them in a one day, but please, the whole objective is that we should be discussing all the recent attempt papers like 22, 23, 24. Is this clear to everyone? But I need the participation from your side as well. So that is just done for the day. Today is a small class, but tomorrow, inshallah, the timing will be a little bit longer than this. And please, I want everyone, please give the mock. Everyone has to give the mock. It's my request. So thank you very much and see you all tomorrow. Have a nice life. Do give the feedback of today's class in your respective WhatsApp groups.